We go to chapter 11, other payables and other receivables. So for other payables, we're talking about the current liabilities, and other receivables, we're talking about the current assets. So for the other payables, so it means we have accrued expenses and prepaid expenses. So we start with accrued expenses. When we talk about accrual means certain amount that is due by the business. The business has used that service or has used the service without making a payment. So that is what we call accrued expenses. And expenses that has been made without making the payment for that accounting year, it is unpaid. So we'll quickly go to the question here. So here they said, Sama started the business on 1st of April 27. He received an invoice for telephone expenses quarterly in arrears during the year ended 31st March 28. His payment for expenses included the following: 30th of June telephone expenses paid in cash $44. 4th of October telephone expenses paid by credit transfer. This is accrued expenses. And 3rd of January telephone expenses paid by credit transfer, $62. All these were paid for. Then an invoice for telephone. Then when here they said an invoice, it means there's a credit transaction, because if there's no credit transaction, it wouldn't be an invoice. It would have been a receipt. So here it's an invoice. It means that Salma has taken certain service without making payments, unpaid service. So expenses for $59 was received on 31st of March 28. This was the telephone expenses up to the end of March, but was not paid until 5th of April 28. Write up the telephone expenses account in Salma's nominal ledger for the year ended 31st of March. Prepare a relevant income statement, a relevant extract from Salma's income statement for the year ended 31st of March. Prepare a relevant extract from Salma's statement of financial position for 31st of March. So here it is. Based on this analysis we have, we're going to open telephone expenses. That's a ledger. We're going to open telephone expenses in respect of Salma. So you have your dates, details, folio, and amount. So the first thing is the first transaction was done. So we have telephone expenses paid in cash. So you're going to have June 30th, cash, $44. Then you have 4th of October. They said the credit transfer, and that's a bank transaction. So we have a bank there, $56. Then on 3rd of January, we have a credit transfer against $62. So the total of that, we had it together. Then we have an invoice. We have an invoice of $59, which means that amount has to be paid. So Salma is a debtor here. So we have a creditor already. So we have $59. So what do we do with this? We add 44 plus 56 plus 62 with the $59. That makes up our income statement for the month of March, which is $221,000. Then we less it. So our income statement is going to be $44, $56, $62, and $59. So $59 will be our balance carried down to add up for our income statement for the year. So the total is $221,000. So our balance brought down will be $59, which is going to go for the 1st of April. Now that is done. I have it here already. So we have the income statement account here. That's the income statement for the cash for $44, bank for $56, the bank 62. And our income statement will be 221. Our balance carried down will add up to be $221. Then the balance brought down will be $59. That's how we prepare the income statement or the ledger for the telephone expenses account. Now we have to open the income statement. For the extract of the income statement, what do we do? For the income statement, we write the total of telephone expenses. For telephone expenses, we have the extra for income statement for telephone expenses. The total of telephone expenses, which is $221,000. That's the amount, $221,000. Then we hope that's going to be the extract for the income statement. So our income statement, we have $221,000. Then we have to prepare a statement of financial position. For statement of financial position, what we're going to have there is our current liabilities, because we are owing we are owing already. Salma is owing. So Salma is a debtor. So Salma has a creditor, which is payable. So we call it other payables. We call it other payables, which is amounts to $59. So that's how we prepare the income statement, the extra for the income statement, the extra for the statement of financial position, and the telephone expenses account. For the telephone expenses account, you add all these transactions together, 44, 56, and 62. You add it together with the other expenses, which is 59. In total, you take it away from 59. 59 will be our balance carried down for the month of March, which will be carried forward to the 1st of April. So that's about that. Then we go to, so that's all about accrued expenses. So for your accrued expenses, it will round up to be other payables. Now we go to, prepayments now, prepaid expenses. For prepaid expenses, it means that the business has paid certain amount of money, which it has not got the services. So that means I'm paying for, maybe I have to pay for 12 months, which in the 12 months, I only need 6 months to end up for this month, for the financial year. So the next 6 months will become a prepayment. That is what a prepayment is. They said here, a prepaid expenses and expenses paid during the year, during the financial year, which relates to the future accounting period. So I wrote here, prepaid expenses. These are advance payments made by the business for a future service. So we have a question here immediately. Here it said, Salma started the business on April 27. Salma rented premises until 1st of July. So Salma was using a rented premises until July 2017, July 27. And when he purchased the premises, he paid a check of $600 for 1 year's insurance on his premises on 1st of July. So Salma paid 1 year insurance from July. And the year, you have to take note that the year will end on the 31st of March because the year started 1st of April. So from 1st of April to 31st of March, that makes off a 12 months for financial year. So based on what we have, they said, write up the insurance account in Salma's nominal ledger for the year ended 31st of March 28. So we're going to open a ledger. To open the ledger, we're going to have insurance account. So they said a check, that means a bank. So on your debit side of your ledger, you're going to have July 1st, 27, bank for $600. And on the credit side of your ledger, you're going to have the income statement. So we have to count. First, we have to find the amount of insurance for each month because insurance is paid for a year, which means 12 months. So how much is Salma paying monthly on insurance? So we say 600 divided by 12, which is $50. So that means Salma is paying $50 per month for insurance. So we have to count from July to March. July, August, September, October, November, December, January, February, March. That is 9 months. So 9 months multiplied by 50 makes up the expenses for Salma for the financial year, which is $450. So on the credit side of your insurance account, on the credit side, you're going to have March 31, 28 income statement, $450, which is for the 9 months that will be spent to end up the financial year. So the balance brought down, the balance carried down will be the difference between the credit side, which is $450, and the debit side, which is $600. So the balance carried down on April 1 will be $150. So $150 plus $450 make up the $600. So in the debit side, we're going to have our balance brought down. So our balance brought down, that means the amount of what we have not used that we have made payment for, our prepayment, will result to $150. Then we have to they said prepare an income statement for the year ended. So for the income statement for the year ended, we're going to have extra from the income statement for the year ended 31st of March 28. So expenses. Then what do we write as the title? The item will be insurance for $450, which has been used. Then the $150 that is left will have to be in our statement of financial position as what? As a current asset, because it is other receivables. For our accrued expenses, it is other payables, which means the business is owing the third party. That is a current liability. But now the third party is owing us. So we call it other receivables, which is what is going to be our current asset. So $150 will be the current asset. So that's how we prepare prepaid account for expenses, for the ledger and the statement of financial position. So the last one we have here is for stationery. So for stationery account, what happens with stationery? These are items bought by the business that has to be used in the business. So we have a question here that said, Samuel started the business on 1st of April 27. During the year ended 31st of March 28, he purchased stationery costing $113. On 31st of March 28, the inventory of stationery was valued at $36. What does this imply? It means that the stationery was used, and at the end of March, at the end of the financial year, the value of the leftover in stationery is $36. So we have to prepare a stationery nominal ledger account. To prepare a stationery account, how do we prepare that? Our stationery account, so we open the stationery account. On the debit side of our stationery account, we're going to have March 31 cash for $113. Then on the credit side of our ledger, we're going to have the income statement. The difference between the amount we bought, which is 113, from the value of the assets, from the value of the stationery, which is 36. So 113 minus 36 will make up our income statement. So our income statement for the year ended will be 113 minus 36, which is $77. So our balance carried down will be $36. $36 plus $77 make up $113. So for the new financial year, our balance brought down for April 1 will be $36. That's how we prepare a stationery account. Thank you. So we've talked about accrued expenses and prepaid expenses. Accrued expenses goes to your income statement, and also we have a current liability for that in our statement of financial position. For our prepayment, it goes to our income statement also, and we have a current asset for other receivables.